So we're just waiting for people to join the webinar at the moment. Okay, so welcome to today's retirement planning webinar. My name is Rita Svensson and I'm the Regional Manager for Australian Catholic Super based in Port Macquarie. And I look after three areas, Armidale, Lismore and Maitland, Newcastle. And today presenting with me, I have Paul Sharp, our financial planner from Sydney. So welcome, Paul.
Hello, how are we all?
Excellent. Look, Paul and I today we're really going to hold a face-to-face seminar in Newcastle, but obviously with the situation with COVID, we were unable to do that. But luckily we have the technology nowadays to actually hold a webinar. So Paul's at home in Sydney and I'm at home in Port Macquarie, even though I'm not in lockdown. But hopefully everything will go according to plan. So thank you very much for joining our webinar. But before we proceed, I would like to acknowledge the traditional custodians of the land on which I work and live and recognise their continuing connection to land, water and community. I pay respect to elders past, present and emerging. So in today's retirement planning webinar, we will be covering a few things. So how much do you need for retirement and where is that being funded from? How and why to build your super balance, accessing your super and how an allocated pension works, and also about Centrelink benefits. And of course, how our financial planners and Paul can help you to reach your retirement goals. And we also have Justin Colley in the background. Justin is looking after our chat facility. So you will be able to direct any questions through the chat facility and we will answer those questions at the end of the webinar today. So we hope that the webinar will go for around an hour, maybe a little bit longer, certainly no more than an hour and a half. So hopefully that'll go according to plan. Thank you. And before we proceed with today's presentation, we have the usual disclaimer that we need to go through, and that's essentially letting you know that today's information is of a general nature only and does not constitute personal financial advice. You can go to our website at catholicsuper.com.au and find our product disclosure statement and also our financial services guide. I'm sure many of you have seen that disclaimer before if you've attended our seminars and webinars in the past. Okay, so Australian Catholic Super and non-government schools, NGS Super, are planning to merge, as many of you would hopefully know. The fund is currently going through the due diligence process, certainly at a higher level and a more detailed level now as well. And I think in August, we'll have more up-to-date information for you on how that merger is proceeding. But it's very exciting news because we are very much aligned, looking after schools, Catholic care centres and other Catholic organisations. So really exciting news and keep an eye out for further updates, certainly through our website. So, the $1 million question, Paul, do you need $1 million in super to retire?
Well, that's a very good question, Rita, and a lot of people do ask me that. I mean, if you were a couple and you had $1 million each, you would probably be quite well off. But potentially you don't need as much as that. If the people on the call are familiar with Scott Pape, the barefoot investor, he thinks you just need 250,000 for a couple. And you can have a reasonable retirement on that. Now, the interesting question is, how does he get to that? So he says, well, you retire at age 67, you would have a full age pension, which gives you about $37,000. You would take 5% from your super, which gives you 12.5. And then you're allowed to work to earn $300 a fortnight each if you work, without affecting your age pension. And if you do all that, you can have $65,000 a year, which is not bad for $250,000. So you could have quite a big range of amounts that you have in retirement. The only issues I have with Scott's picture there is, first of all, you can't retire till you're 67 and you can get the age pension. And you also have to find these jobs that will pay you just $300 a fortnight and no more. And you're going to have to keep them till your life expectancy, which people may not be able to do. So it is a different question then. It's going to be an individual thing. And you say, if we pop onto the next slide, really it's going to be about your retirement goals. One big question is, what is your retirement going to look like? Is it going to be international travel, flying around the world, cruises, lots of going out? Or is it going to be a quieter time with the family, simpler holidays, and doing the garden? Because that will affect the first aspect of retirement planning, which is how much are you going to spend? And that's going to be a very individual thing.
So, Paul, have you seen with the clients at the moment any changes? Because I guess a lot of people probably would have thought that travel was on the horizon for them with retirement, part of their plans. Has that been changing at all recently?
Yes, it has. When we do our retirement planning, Rita, we always do ask people to do a budget, because we want to, as accurate an idea as we can of what they might spend. And what I'm finding is that line for holidays is looking a bit small. And then we have to have a discussion with the client, say, well, that's okay, but that's probably only the case for the next 2 or 3 years. We are now looking for your retirement, which we hope will be 20 or more. And so we're finding that those budgets are having to be flexed a bit so that they're not so high now, but then have to increase through 3 or 4 years' time, because most people do want to do that travel when they retire. They've got their bucket list and that's what they want to do.
Absolutely. But you mentioned that word budget, and I know a lot of people do struggle with budgeting, but it is very important, isn't it, to know actually, I guess what your current budget is before retirement. So that will give you an idea of maybe how much you want to spend in retirement as well, or how much you may need.
Yeah, and that's a very important part of the process. If we flick to the next slide, as for the Australian Superannuation Funds Association does give some guides about what retirement might look like and how much you might need. And they talk about a comfortable lifestyle, a modest lifestyle, and then there's what you might be able to afford on the age pension. So these are quite helpful guidelines for a couple. It's about 62,000 a year for a modest lifestyle. So Scott Pape's couple on 250 grand I actually got a comfortable lifestyle, providing they can keep doing that work. And then it's a modest might be 40, and a couple on a pension are going to get the 37. But even the modest, the comfortable lifestyle, it's not extravagant. It's talking about 1 annual holiday in Australia. You might be able to eat out at restaurants. I like this one. You can afford bottled wine. Whereas on a modest lifestyle, you have to have cask, and if you're on the age pension, you have to start home brewing. But it's not you can afford a reasonable car, you can get your hair cut, but it's the comfortable lifestyle is comfortable, but it's not extravagant. And what people need in retirement, what their budgets are, I've seen clients with budgets and requirements for anything between 25 and 100,000. So it does
be very varied.
It's quite a varied number, and it's a very personal thing.
Yeah, and I guess the figures that ASFA does provide, it is based on actual figures, actual surveys of people that have retired around Australia in all the capital cities. And if you do Google just ASFA retirement standard, you can go to their website and you can find all this information there. And I think they even drill down into a very detailed fortnightly budget that you can have a look at.
Yes, they do. There's quite a detailed budget with quite a lot of line items in it. So quite an interesting read.
Yes, a very good place to start though. Gives you an idea.
Absolutely.
So I know that superannuation is not the only asset that you may have for retirement. I was talking to a lady just yesterday who actually has a lot of Commonwealth Bank shares outside of superannuation, and she also holds an investment property. So I guess, Paul, there's all the different asset classes really to have a look at with your retirement savings.
Absolutely. So most people's retirement, and super we'll come on in a second to say super is an important part of retirement funding, but people also do have cash. They would have their shares, they've got their investment property. Even the family home comes into the picture for a lot of people at some point.
Yes.
I'm still living in the home that we brought our family up in. I suspect in 10 years' time, it might be a bit big for us. And that will be the same for a lot of people. So that will come into the picture as well. One of the important things we focus on with the advice, retirement planning advice, is also making sure that we're making best use of those assets. So, for example, cash at the moment, if people have a lot of it, is that the right place to have it? What are we going to do with the investment property? Does it have debt on it? Are we wanting to sell it at some point? And so on. So that's part of the planning process, would be to look at all that picture. For most people, many of those aspects would come into play.
Absolutely. And we will be talking a little bit more later on about the family home as well and how to utilise that. So essentially, Paul has just explained to you, I guess, the holistic look at retirement and the assets and so forth. But obviously, superannuation really does form one of the best ways to actually build that retirement nest egg. Paul, would you like to explain to us why that is so important?
Well, super is one of the important things about super is that it's a very tax-effective means of saving. So in what we call people's super or accumulation account, your fund will only pay a maximum of 15% tax on its investment earnings. Now, if you're outside of super and you invest that money outside of super and you earn anything more than $45,000 a year, you will pay around about 35% tax on those investment earnings. So that's true for an accumulation account. It's also true for a transition to retirement pension. But the good news when you retire is that an account-based pension, which is what a lot of people open up to get their regular income, doesn't pay any tax at all on its gains. And you'd see on our website that if you looked at the same investment options, because of that tax reduction, a pension account earns 0.5% to 1% more on its investment gains than the super account.
Absolutely. Yeah, thanks, Paul. So talking about concessional tax, I guess, certainly the best way to actually build that superannuation balance is by making pre-tax contributions. So that's salary sacrificing into your superannuation account. And as you can see on the slide there, if you're earning under $18,000 a year, well, essentially you're not paying any tax. But most people are in the $45,000 to $120,000 tax bracket. And as you can see there, your marginal tax rate is 32.5%. So when you direct any monies into your superannuation fund, as Paul just explained before, that money's only taxed at 15%. So you automatically have a tax savings there. And obviously, as your income increases, your marginal tax rate increases, and hence the savings when your salary sacrifice also increase. So I'll get Paul to go through an example of salary sacrificing, please.
Yeah, so here we have it. So like we said, super's a tax beneficial environment because the fund doesn't pay tax on its gains, but you can also save tax when you put money in. So here's a member who's on 100,000 a year, and they've decided to sacrifice 5% of their salary. Now, basically, that means their take-home, they salary sacrifice $192. But by doing that, they are saving $66 a fortnight in tax. Now that's $1,700 a year, or $17,000 over 10 years. So every time that person puts in, let's say they put in $1,000, they, instead of paying 35% tax and taking home 650, they put it into their fund. They only pay 15% tax, and they have 850 in their fund.
Excellent. Thank you very much. So salary sacrifice contributions and your superannuation guarantee contributions, which are now up to 10% from 9.5%, and any personal deductible contributions, they're all included and treated the same way. So they are your concessional contributions. Now the limit has also increased from the 1st of July. So the concessional contribution cap is $27,500 from the 1st of July this year. So all those contributions are taxed at 15% on entry to the superannuation fund. Now, Paul, there is something called the carry forward rule. That we were chatting about this the other day. And I know that many of the clients that you see actually don't utilise this particular provision.
So this is relatively recent legislation, but it used to be there was an annual cap, and if you use it or lose it. So if you didn't use the whole thing, then you just started again the next year with the same cap. Now, as of the tax year 2018-19, you've been able to carry forward any of that cap that you didn't use, so long as your balance is under $500,000. That carry forward lasts for 5 years. So as we move through time, the amount of cap that members have available for these tax saving contributions for some people is getting bigger and bigger and bigger. Even on a $100,000 salary, you might have roughly 10,000 going into your super from your employer. But if you go back now 3 financial years, that's 45,000 of contribution cap that you haven't used. Add that to your 27,000 for this year, you've got almost more than your take-home pay that you could put into super. So many of our members will have a very, very high ability or cap to put the money into super. One of the things we consider with advice is how best to use that, because you don't necessarily want to use it all in one tax year and take your income down so low that it's not really saving you much tax. But that's it's an ever increasing benefit or tax benefit that members can take advantage of.
Absolutely, Paul. I also know that can be a very complex area as well. And I would certainly recommend, if any of our members are wanting to look at that they actually do get some advice in that area. Okay, so pre-tax contributions aren't the only contributions that you can make to your superannuation fund. You can also make after-tax contributions. So they're contributions or money that you've already paid tax on. So now from the 1st of July this year, that has also increased. If you are under the age of 67 now as well, it used to be 65, you could potentially contribute $110,000 per financial year into your superannuation account. And you could also potentially bring forward another 2 years worth of contributions and contribute $330,000 in one financial year, but then not make contributions for the next 2 financial years. Obviously, these amounts are quite large sums of money, but Paul was talking about earlier about investment properties and share portfolios and so forth. And sometimes people also get an inheritance. So this gives everyone the opportunity to actually contribute more into their superannuation for retirement. So if you are over the age of 67, between 67 and 74, you don't have that bring forward rule available to you, but you can contribute $110,000 per financial year as long as you meet the work test. And the work test isn't too onerous. It's just working 40 hours in a 30 consecutive day period in that financial year. And I have also heard that the government is looking at potentially removing that work test from the 1st of July next year. So that's a wait and see what happens there. So that would be another good change. And of course, once you reach age 75, you can no longer utilise this non-concessional contribution cap as well. So very important to keep in mind the different ages as well.
Yeah. Sometimes people ask me, why would I do that? Why would I just put money in like that and not if I'm not saving tax? But bear in mind that there's a couple of reasons. Often people's money outside of super is invested in cash. There are managed funds and investment vehicles outside of super where you can invest in more diversified portfolios, but people tend not to have them. So that's one reason. So you'd have a more diversified portfolio, you'd be invested in more growth assets, you've got a chance for better return. And also don't forget that the super fund is only going to pay 15% tax on its gains. So those two factors still apply, even if you're not saving tax on the actual contribution.
Absolutely, Paul. Okay, so Paul, I mentioned this a little bit earlier about the family home and so forth. So there are other ways to also contribute to your superannuation. Could you please go through them?
Yeah, sure. So the downsides are, again, relatively new, but what it allows you to do is if you sell your main residence and you're over 65, there's a few rules, but basically, so long as you've owned that main residence, or what if you're a couple, one of you has owned it for at least 10 years, then if you sell that main residence and you're over 65, you can put up to 300,000 into your super. And that's 300,000 each if you're a couple and you're both over 65. There is no age limit on that contribution. And the 300,000 doesn't count to either of those other caps we've just talked about. So it is a good way that what the government's doing, it's encouraging people to release capital so that they can fund their retirement rather than being more dependent on the age pension. But again, something where a little thought is needed and maybe some advice, because under the Centrelink rules, Centrelink's means tested. And there is a test of how many assets you've got. Your main residence does not count to that assets test. If you convert it into cash, the cash does count. So then it's a juggling act of, well, am I giving up age pension? But on the other hand, do I need the cash to fund my retirement? So that has to have some thought around it. Other contributions, spouse contribution, yes. If your spouse is earning less than $40,000, then, or 37,000, essentially you can put up to 3,000 into your spouse's super and you will get a tax offset. If your spouse is earning 37,000 or less, that tax offset is $540 for a 3,000 contribution. You don't get any more after that. Once they're earning over $37,000, the offset starts to get smaller and runs out at 40. But that's another way you can put money into super and save a bit of tax if your spouse isn't earning a high salary.
Yes.
Consolidation, another one to think about. A lot of people do end up with multiple accounts over their career. Often people say, well, does that mean I'm paying multiple fees? Not necessarily, because a lot of the fees on superannuation funds are a proportion of the account balance. You may have a duplication of their membership fees and so on. But what you might be duplicating, which needs to be looked at, is insurance. So you may have multiple insurance policies that are eating away at small accounts. You may not need that insurance. And particularly if you have income protection insurance, that needs to be reviewed, because if you have several policies and one is paying you, the others won't pay. So worthwhile having, if you think you've multiple accounts, have a look at them, see what you're paying, and also check the insurance.
Absolutely, Paul. Yeah, very, very good advice there. And we can certainly help you if you need help locating lost super at the fund. You can also go to MyGov, a very good place to actually have a look at the different superannuation accounts you may have out there. You just need to go to have the ATO linked to your MyGov account, and then there's a superannuation section under there. Okay, so now that we've spoken about how best to contribute, now it's actually looking at when you can access your superannuation. So essentially, when you reach your preservation age, so that's 58, 59, you could potentially access your superannuation if you genuinely retire from the workforce and sign a stat dec. Eventually that'll go or phase into age 60. But when you reach age 60, you're between 60 and 64, it's a slightly different rule. You actually have to cease an employment arrangement. So some of you may be working in one particular diocese at a particular school. If you resign from that employment and work in a different diocese, that is ceasing an employment arrangement, for example. So you could access your superannuation then. And of course, once you reach age 65, you can access your superannuation whether you are working or not. So very different ages, and there's a lot of options available to you, particularly once you reach age 65, because you're not forced to do anything with your superannuation at that age. So Paul, can you take us through what would happen though? You can actually access your super as a lump sum, and then we will certainly go into how an allocated pension works with that income stream.
Absolutely. So I guess we've talked to date about how you're going to contribute and build your super and get that sum that you want for retirement, but at some point you're going to want to access it. So basically there are two ways to access your super. You can take lump sums, or you can take an income stream. If we go to the next slide, what this describes is, so you've spent your working life building your super. You've put in your contributions, you've done your salary sacrifice, your employer's put in money, you might have popped in some lump sums, and so on and so forth. But a superannuation or accumulation account, as we call it, you can only take lump sums out of that. What a lot of people want is a regular income. So what they want to do is replace that paycheck they've had most of their lives with another regular source of income, and an account-based pension or a pension account allows you to do that. So you can, most people move their money into an account-based pension, and then they can take a regular income, and they can take a fortnightly pay just like they had in their pay packet. So that's one benefit of the account-based pension. It allows you to take regular income, and also, as we said earlier, it earns a little bit more because its earnings are tax-free. But there is a minimum that you need to take out of your account-based pension. Roughly speaking, for anybody between 65 and 75, it's 5%. And at the moment, because of COVID, it's actually only 2.5 for the rest of this financial year. So again, considerations: if you don't think you need a lot of income, you don't have to put all of your super into a pension account. You can put some of it. And that then will control the amount that you're having to take out, because you may not want to have money coming out that then you can't put back. So that's the main vehicle for how people take their retirement income.
Absolutely, Paul. And something that I know a lot of members ask me is, or they get a little bit confused about, is that you can never add to a pension account. You can only add to your superannuation account. So that's your accumulation account. So just one point to keep in mind.
Yes.
And so now, Paul, we do have a couple of different products with our allocated pension at Australian Catholic Super. Could you take us through the first one, RetireChoice?
Yeah, so probably RetireChoice is our, it's probably our most popular account. It's one most people use. It has, as it explains, you can invest almost in any of our investment options. So it's very similar to your super account. It has the complete range of investment options to invest in, apart from the lifetime one, which is obviously a super related investment, which changes over time. And it's flexible in the sense that it can accommodate almost any sort of investor. So if you're ultra conservative, you could invest entirely in cash, or you can invest in different options with different mixes of growth, right up to, if you really wanted to, you could invest entirely in shares. So it does give you that flexibility to invest, but it's still got the main features of giving you the regular income and getting the tax benefit of the on the returns.
And then we also have our RetireSmart product as well.
So that's a slightly different approach. It has two investments. It has money in cash, and it has money in a fairly high growth option. And the idea here is to use the cash to actually draw your pension. And then we sort of control the way the cash is topped. The cash has to be topped up to keep paying your pension payments. But we sort of control how that cash is topped up depending on how well the share market's doing. So any dividends from the shares or the investments that the growth investment has will always go into the cash bucket. But we won't take capital from the cash bucket, the growth assets bucket, until the share markets or the performance is at a certain level. So the idea is to control how we draw on it, and draw on it when in the good times when the markets are up, but not draw too much when the markets are down. And that's another way of controlling and trying to manage your pension payments.
Absolutely. Thank you, Paul. So now that Paul has explained the mechanics of how an allocated pension works, probably the next question that you may have is, well, do I have enough to retire? And when can I retire? So I guess, Paul, this is what you do.
Yeah, this is the core of our advice offering for retirement planning. It's the question most people have. And the answer will vary a lot. It depends on three questions. When do you want to retire? People will come and say, I want to retire next year, and they're 62 next year. That's fine, but that means you have 5 years in which you have to fund all of your income, either through your savings or work, before you can get Centrelink. Or people might want to retire later. There's then the question of how much do they need for retirement? What's their budget, which is why that budgeting exercise and thinking about what your retirement's going to look like is so important. And then there's the question of how long is the money going to last? Because Life expectancy these days is about 87, I think, particularly for females. Female life expectancy is still a bit longer than males. But when I talk to clients and they say, well, you know, what about your parents? And they start saying, oh, well, my granny lived till she was 100. The amount of time you need to think about funding your retirement can be quite long.
Yeah.
So the sort of discussion we'd have would be like this. As you can see in front of you here, we've got Gary and Mary. They're 65. They want to retire. They've got 600,000 in their super, and they want 63,000 a year. So that is potentially going to use up some of their capital. You know, a typical return, the sort of return. Actually, flip back one. The sort of return that you might, you know, if your super's earning 5%, their super's not going to earn enough to cover all of that income. On the other hand, as we come back later, we'll show later, they might be entitled to some Centrelink at some point. So we've got to put a projection. We will put a projection together that will look at how much they need, where it's going to, what sort of returns they might get on their super, at what point will Centrelink kick in, and we're going to do some analysis to see if this scenario will work for them. So what we then get is the typical output is something like that. So this would show their assets. They've got 600,000 now, and this couple is going to be okay. Their assets are not actually going to run out until roughly age 93 for Gary. So their money's going to last a long time. They've got their 63,000 a year, but and this is just a second chart showing the same thing. So they've got income, but interestingly, if you look, there's income from two sources here. So the maroon is, or the purple is what's coming from their account-based pension, which is obviously 100% in the first couple of years because they're not eligible for the age pension. But then the age pension does kick in. They don't get a whole age pension for a few years, but by the time they're 73, they're getting the full age pension. And that's covering quite a lot of their income needs at 37,000 a year. And that's not uncommon. For most of the people that I see, Centrelink will kick in at some point, and it's providing quite a bit.
Yeah, that will certainly be the case. I think Paul has frozen at the moment, from what I can see myself. Not sure if he can actually fix that issue at the moment.
I can see you, Rita. It all looks to be going okay. Can you just try and go to the next slide?
Yes, I will do. So
yeah, it's working from our end.
Yeah. So Paul, hopefully you can hear us. You've still frozen.
Okay, Rita, it looks like we've lost Paul for the time being. I'm happy to take over Paul's part. Paul's logged off. And so
thank you, Justin. Very good. I'm sure Paul's going to try and link back in. That's what happens with technology nowadays, doesn't it?
It certainly does. So
yeah. Thanks,
yeah, it's always
Justin.
good to jump in.
Yeah.
So yeah, we're up to the age pension eligibility. So it really depends on your age, the criteria. So it is pushing out to 67. We are currently at 66, but going out to 67 over the next year or so. You do need to be an Australian resident to be eligible for the age pension. And also you need to meet an incomes test and an assets test. And Paul touched earlier on the payment rates, where we spoke about the comfortable and modest lifestyle, and we'll touch on those shortly as well. So if you just move on to the assets test, here are the age pension ages there. So depending on when you were born, so if you were born prior to 30th of June 1955, your age pension age now is 66. So people now, if you were born prior to 31st of December 1956, your age pension age is 66 and a half, effective only just a couple of days ago. And as I mentioned earlier, the the age pension is going out to 67 for people born after 1 January 1957. So I can see Paul's back on online now.
Wow.
So I'll let him take over from
Don't you love technology?
Yes, it's how it goes. But luckily we had Justin to help us out, Paul. So
good, excellent.
Just finishing up on this slide here.
Okay, the age pension. Yes, before I was cut off. The age pension will come into most people's retirement plans at some point. And essentially for anybody born after 1st of January 1957, it's going to be 67.
Mm-hmm. Not to be confused though, of when you can access your superannuation from age 60 in particular. I know a lot of people do get the two confused sometimes. So yeah.
Absolutely. So that's important. Yes, you can access your super at 65, but you can't get the age pension until 67. Yes. So if you're intending to retire before 67, you're going to need more money to
absolutely
in the meantime.
Absolutely. That will take us now on to I guess the asset test for Centrelink, Paul.
Yeah, so Centrelink is means tested. There is an assets test and there is an income test. And if your assets are under a certain point, you will get a full age pension, which is roughly 37,000 for a couple and about 24 for an individual. We'll show the exact figures coming in a minute. So if let's say you're a couple and you own your own home, that's fairly typical. People I talk to, if your total assets, and this is excluding your main residence, are less than 401,000, you will get a full age pension. The important thing to note is this grey area in the middle, because it's not an all or nothing. Your age pension will reduce if you have more assets over that. It's $3 a fortnight for every 1,000 of assets over that, but it doesn't run out completely until you've got 880,000 of assets between you.
And there's also an income test.
There certainly is. So again, this is again for couples. So you can have up to $316 per fortnight between you of income and get an age pension. And it won't run out completely until your joint income is $3,188 a fortnight. Now that includes Centrelink's assessment of your investment income. So whatever financial assets you have, they have a process called deeming, where they work out a standard rate of return on those assets, and that is included in that income. So it's not just earned income. If you want to work, then there is a thing called the work bonus, which, as I mentioned earlier when we started out, allows you to earn up to $300 a fortnight each, and that does not affect this income test. So you can work a bit, that's the idea. It has to be earned income, it's not investment income, but you can work a bit and still and not affect that income test. The way Centrelink works is they do both tests, and whichever gives you the lower level of Centrelink is the one that prevails. Actually, whilst we're on it, there was a question I noticed there about, does your super count? It doesn't count if it's in super or accumulation if you are under age pension age. And that is something that we look at, particularly with couples where there's a significant difference between their ages. Important part of advice, we may be able to rearrange the assets so that we have less that are tested for Centrelink, and so the older of the two gets more pension. Another important part of the process. So that's the Centrelink pension rates. Pension rates, as I said, $24,770 for a single person, a couple, 37,000 if you're both receiving the age pension, or 18,000 if it's just one of you. the way Centrelink works is if you're a couple and one of you is not eligible for the age pension, all your assets and everything is counted, and then the older one gets half of what you would be entitled to as a couple. If you're a couple that are apart due to ill health and one is in hospital or a hospice, something like that, and you're both entitled to the single rate.
Yeah. Thank you, Paul. And there's also the Commonwealth Seniors Health Card that I know a lot of people are certainly interested in.
So that's another card. If you're not eligible for the age pension, often because of the assets test, there's always the Commonwealth Seniors Health Card. Basically, most of what it gives you is cheaper benefits. So you get a reduced level of charge on prescriptions, and there's a cap on how much you have to pay in any 1 year, after which it's free. Quite a valuable card. Estimates say it could be worth $1,500 to $2,000 a year. That's if you're in reasonable health. If you're not, it could be worth a lot more. The nice thing about the seniors card is that the assets test doesn't apply. It's just an income test, and the income test is a little bit higher than Centrelink. It's about 80-odd thousand a year.
Mm-hmm. And most people really do fall under the assets test, generally speaking, don't they, Paul?
Generally speaking, for Centrelink assessments, the assets test hits most people before the income test does.
Mm-hmm. Absolutely. So then there's also the opportunity to have lower rates and bills and discounted public transport fares as well. So yeah, I think that all varies a bit from state to state.
Yes, it does.
Okay, so now that we've gone through Centrelink and so forth, and all the rules and regulations, as you can see, it's a very complex area out there. There's a lot of different things to take into consideration, and certainly this is where a financial planner can certainly help you. So Paul, would you like to take us through exactly how you help our clients?
Yeah, so these are typically the topics on which we're advising. The core, if you look at the 2 dot points in the middle, is what we've talked about so far. That's what most people want to know. It's the bread and butter of what they're going to pay for with advice. What are their goals? What are their aims for retirement? And how long will the money last? In other words, is it going to work for them? So we looked at Gary and Mary. They wanted to retire age 65. They wanted 63,000 a year, and they wanted to know how their money would last. But that's not what we do. I mean, that's the bread and the butter. The way I think about it is I want to put a bit of jam on that and see if we can find some other strategies that will add some significant benefits. Centrelink was one. As I said, if there's a significant difference in ages, we can look at shifting money into the super account of the younger one. That will then not count for the assets test. We can get more age pension. That's as long as you trust the super one. That's as long as you trust the younger one, of course. And then can we save money? So have we made complete use of all those tax saving strategies, contributions, and so on and so forth? Oh, hang on. Can we just flip back? Estate planning is another. So there are ways, I won't go into a lot of detail, but things that we do look at to reduce the amount of tax that your beneficiaries might pay if you pass away. The other thing we can do is look at non-super investments. So investing money outside of super. As I said before, not a lot of people do this in reality, but you can have your money invested outside of super in exactly the same sorts of investments as they are in super. And again, sometimes that's beneficial for couples that can't put money into super and or where they've reached an age where they've no other income, they're not really paying any tax. Then potentially that might be an alternative to a super fund, which would pay tax on its earnings. So all sorts of things that we can look at. The core is retirement planning, but then everything I do is to look around that and see, well, where else can I add some value?
Absolutely, Paul. So it certainly can give you peace of mind as well. You know, it's not just about all the financials. I know a lot of people don't understand finances very well. So if you need, you know, assistance with that, that's where the financial planning service certainly does help.
Absolutely. So the regulators say that we must be able to demonstrate that we're adding value if we're giving people advice and charging a fee for it, but that value isn't always necessarily monetary. Somebody might well just want to come in and have a look at the way their money is going, how is it growing, and is it on track to meet their needs? Because we may have looked at it before a few years ago and said this is what you need to do. Obviously we need to review that, and if that review says yes, everything's okay, that is you know, that's valuable in itself, or can be, to the member, to give them that comfort. Yes, everything's okay, what I'm doing is fine.
And Paul, could you just explain how the cost works for our comprehensive advice services as well, please?
Yeah, sure. So we, if you've never seen us before for comprehensive advice, you get a first meeting that's at no charge. You don't get any advice in that meeting, but we have a long discussion about where your circumstances are, what your goals are, what your needs are, confirm what your financial situation is. At the end of that meeting, I would then quote a fee for advice. We're a not-for-profit fund, so that fee is essentially to recover our costs, but it does have to cover the time that we're going to spend on the advice and so on and so forth. But it's what we call a fee for service. So you would only pay us when you come for advice and when I do work for you. If you don't come back for the next 5 years, you don't pay us anything. We don't put any ongoing percentage on your account. We would only do work when you come back to us for review.
Thank you. So we have different levels, I guess, of advice where we can help our members. So Paul, would you like to explain? I know you just went through the comprehensive side of things. Can you please explain the other types of advice we have available at the fund?
Yeah, so general advice, all the advisors can give this, and you could even get it from our call center. But general advice is general information about what are the ins and outs of super, the rules, and you know, things you would need to know. So we could tell you about contributions caps, the bring forward rule, the carry forward rule, the downsizer contribution, and whatever you wanted to know about super. That is general advice. It's not taking your specific circumstances into account, and it's not saying, I think you should do this, that, or the other.
That's
so
right. That's essentially what I do in my role as well. Yeah.
So anything you then did subsequent to a general advice conversation, we always have the warning that you need to take your personal circumstances into account if you're going to act on it. Any circumstance where we say, I think you should do the following, is advice. So we have two forms of advice. Comprehensive, I've talked about. That's where we're taking, often see people as a couple, we're taking their whole financial circumstances into account. We're advising, we're giving projections for the future, and we're advising across a whole range of strategies. Not everybody needs that, so we do have an over-the-phone service, and that can advise all our members on their investment within the fund. So just look at where you are. Most people are in the lifetime one. How is that invested for you? Does that make sense? Are you comfortable with that? We can talk about contributing to the fund. So look at different strategies for contributing and how much people can contribute, whether they're going to hit the caps or not, and so on. And that advice also does give a projection of what your super might look like on retirement. And also within the fund, we can advise on insurance. We do have a restriction. We can only advise members who only have insurance with the fund. So that's your life insurance. The over-the-phone advice doesn't have a license to compare between different funds. So if you've got insurance elsewhere, we can't do it. But otherwise, everybody within the fund has a basic default level of cover. But it is default, and it may well not meet your circumstances. It might not be enough for your needs. So that's another thing that we can look at with the over-the-phone advice. that advice is at no cost, and it's over the phone.
Absolutely. Thank you very much for explaining that, Paul. If anyone online at the moment is actually interested in over the phone advice or comprehensive advice or having a general chat, even with myself, you can click on the link now and we will arrange those appointments for you. Okay, so other webinars to keep an eye out for on our website. Certainly on the 8th of August, I think it is, our quarterly investment webinar. Our Chief Investment Officer, Michael Block, holds that webinar, and he is very, very good at explaining some very complex information in very easy to understand language. And you also have the opportunity to ask Michael questions. So certainly a worthwhile webinar to register for. We'll be holding a Centrelink webinar at some point in time with more detailed information as well, and certainly an aged care webinar. I know that area can be very complex. Maybe you have elderly parents that might be going into care. I certainly can say that is very complicated. I have been through that process myself. So yeah, very complicated calculations there. And then we'll obviously have some more retirement planning webinars available as well, but hopefully we might be able to go back to some face-to-face ones later on in the year. So you do need to register for those via our website on catholicsuper.com.au. So keep an eye out for all of those. So the other thing I wanted to mention was if you haven't registered for our member portal, it certainly is worthwhile. You can do a lot of things through our portal. You can look at your account balance, you can make contributions, you can do investment switches. So there's a lot of things. Look at your investment returns. So a lot of information there, and I certainly do recommend that you register. If you need some assistance, please contact our call centre and I'll give you those details in a moment. Or you can also make contact with myself and I'm more than happy to help you out. So here are our contact details, our 1300 number. Our call centre is even open on a Saturday from 8 till 5. So our website, once again, catholicsuper.com.au, and you can find a lot of information there. So thank you very much. And now I will hand over to Justin to see what questions we have. Thanks,
Rita. Thanks, Rita and Paul, for that informative session so far. And we've had a number of questions that have come through, which I'll go through now and direct them to you both. So the first one was, how much can you have in your super and still earn a full age pension from Centrelink?
I'll take that one. So it's not just about your super, it's about your financial assets, which, as I mentioned, don't include your main residence. But if you're a couple and you own your own home, then you can have up to 401,500 and still both get a full age pension. Centrelink distinguishes between homeowners and non-homeowners. So if you're a non-homeowner, it's 616,000, and then you would get a full age pension. There was another question about super. Your financial, so that's your financial assets, excluding your main residence. The question did say, how much can I have in my super? If one of a couple is under age pension age, then their super, as opposed to a pension account, doesn't count either.
Thanks, Paul. So the next one is, can you also withdraw a lump sum to save to go on a holiday if you have a pension account?
Yes. It's a simple answer. To have a pension account, you have to have met a condition of release, unless it's a transition to retirement pension, but that's a separate story. But for a normal account-based pension, you have to have met a condition of release, in which case you've got full access to all of your money whenever you want it.
Great, thanks, Paul. So the next one that's come in, and I'll direct this to you as well, Paul, is do you have any advice on lifetime pensions, e.g. like the one offered by Q Super, a competitor of ours, offers?
They need to be looked at for the individual. The thing with lifetime pensions or annuities is you're essentially getting a fixed level of income. To be honest, I couldn't really say right now. It's the sort of thing you have to look at in an individual context.
Great, thanks, Paul. They've really answered this one before as well. Is your super counted as part of your assets? And you just answered that in the previous question as
Correct.
well.
Correct. Yeah.
So the next one we've got, if your preservation age is 58, is there any tax advantages in waiting until 60 to access your super?
Well, yes, because it depends. Many of these things depend. But if your pension age is, if your preservation age is 58 and you are retired, but under 60, that means you're not intending to work again. Then if you're retired, you can access your super. And you can take a lump sum up to, I think it's now 210,000, and you won't pay tax on that.
I think it's up to 225,000 now.
225. It's gone up. Yeah. It goes up every year. So anything else you take under 60, if it's more a lump sum or it's an income stream, you will pay tax on, and you'll pay it at your marginal rate less the 15% contributions tax that you paid on the way in. Once you get to 60, you will not pay tax on anything that you take out.
Great, thanks, Paul. The next one is, am I able to ask if you know anything about the new scheme where you can add money to your super to save money for a new home? So it's a first home saver scheme.
First home.
Go that one.
Paul can.
I've not actually dealt with it. Most of the people I see are close to retirement, but essentially what it's doing is, if somebody wants to contact me personally, I'll send you a fact sheet on how it works. But essentially what it's doing is allowing you to put money into your super particularly using the tax concessions, and have that in your super, and then draw out what you've put in to go towards a new home. So what it's allowing you to do is use the tax concessions of super to give you a bit extra to put down on your home deposit. But there are rules about how much you can put in and how much you can take out. And they've just changed as well.
Yeah, I thought it used to be $15,000, I thought, but
it went up in the last budget.
Yeah, and I know that the tax office actually do really, you have to apply through the tax office as well to actually access that.
The only issue with that is it's something you'd need to take advice on, because if the money just goes into your super, into your general super investment, particularly if you're younger, that could be quite aggressively invested and have a lot of shares and things in it. And that could go down as well as up.
Yeah.
So something short term as investing for a home deposit, you might want to get advice and see if you can make sure that money goes into a separate vehicle that's not going to be as volatile.
Thanks, Paul. Rita. So, Rita, I'll direct the next question to you. It is, what does preservation age mean?
Preservation age is the age that you can access your superannuation in some form. We spoke about if you reach age 58 or 59 at the moment, and if you genuinely retire from the workforce, then you can access your superannuation. But you may also be able to commence a transition to retirement pension when you reach your preservation age of 58 or 59. Okay, so lots of different rules and regulations. So that's what your preservation age is, I guess, and 60 as well, but different rules as we spoke about earlier as well. So not having to genuinely retire, but actually if you want to access your superannuation, then you need to cease an employment arrangement. But again, you could still also commence a transition to retirement pension from that age as well and continue working.
Thanks, Rita. The next one is, and I'll direct this one to Paul. What happens if I want to retire at 63? Can I receive the age pension if my husband isn't eligible?
Not at 63, no. The age at which you can receive the age pension depends on your date of birth. For most people who are born after 1957, that age pension age is 67. It varies. It's an earlier age before that. So if you're born between, for example, July 1955 and 31st December 56, it's 66 and a half, and so on and so forth. So whether your partner is receiving the age pension or not, each individual can't receive the age pension until they've achieved the age pension age. It doesn't stop you retiring or accessing your super. As we mentioned before, everybody can get their super at age 65. Before that, you can get your super if you're retired. And over the age 60, the definition of retirement is having given up an arrangement of gainful employment. So that even stretches to having 2 jobs and giving up one of them. So as long as you're retired or you meet that definition, you can access your super and you can retire. The big issue then is if you're 63, that's 4 years potentially until you can get your age pension. So then we have to figure out, can you fund your expenses in the meantime?
Right, thanks, Paul. I'll take the next question. So we were late joining the webinar. So will there be a recording of this webinar that we can access to listen to? We will work to get it on our website. However, if you want to view it pretty much straight away, this webinar is actually being streamed live on our Facebook page of Australian Catholic Super. So that is then recorded or left on our Facebook page, and you can go back and rewatch it at any time through Facebook. So the next one is, and the person just thanking us for the opportunity to do this through Zoom during these difficult times where we're all in lockdown. The next one is, we've got a 7-year age difference. Can older, in brackets 71, get a pension if the younger is still working, earning 80,000, but sacrificing down to 60? I'll direct that to you, Paul.
You might. Your income, if the younger one is still working and earning 80,000, they'll be subject to the income test. For Centrelink, they will add back they'll add back the salary sacrifice. For most of these benefits for tests, there are varying income tests, and they're all slightly different, but they basically would add back the salary sacrifice. So, and also would include the estimated or deemed income on your, or at least on the older one's assets. Potentially not the younger one if the younger one's assets are all in super.
Great, thanks, Paul. Rita, I'll get this one to you. The question is, if you retire and asked to do casual work at your last school, is this allowed? Should there be a break?
I don't mind for jumping there. Yes, there should be a break. If you're over 60, if you finish full-time employment, then you would have counted as giving up an arrangement of gainful employment. But the fund does go back to schools and check, is this person retired? So a lot of teachers, that's one trap for teachers, is that they leave their name on the casual books. And the school then says, oh no, they're still on the books. So there needs to be a clean break between stopping full-time and going back casual. It doesn't have to be very long, but just enough so that we can satisfy ourselves that the person is retired, and then we can make all their super available to them. If you then go back casual, fine, not a problem.
Okay, thank you, Paul. The next one, I'll go to you again, Paul, is I've reached my preservation age. Can I access my super for a deposit on property if I'm still working? No.
Unless you've used the first home buyer saver scheme. So if it was your first home, you might be able to get access. You'd only be able to get access to contributions that you've personally made. But otherwise, if you've say if you're under 65, you have to be retired on either of those two definitions that we talked about to access your super.
Right, thank you. The next one is actually just going back already to that preservation question. The lady, as I said, she didn't really understand the answer. What does it mean when you reach 58, 59? How is the criteria determined?
Okay, so preservation age, you put it another way, it's the first age you can access your super without being either in financial difficulties or totally and permanently disabled. So it's the first age at which you can access your super through being retired. And there are just two definitions of being retired. If you're under 60, you have to be retired and not intending to work again more than 10 hours a week. But if you're over 60, the definition changes. It's like quirk in the system, but you have to have just given up an arrangement of gainful employment or changed jobs. So if I stopped working for Australian Catholic Super tomorrow and started again in a week's time with First State Super, or Aware as it now is, I would count as retired, even if I'm not. But that is the definition. So you have to have given up an arrangement of gainful employment, changed jobs, and or if you happen to have two jobs, give up one of them. And you count as retired. So it's just a quirk in the system that once you're 60, the definition of being retired changes.
Thanks, Paul. Now, that was actually our last question, but just to clarify that lady, and for all the questions that have been asked, we'll get the local regional manager in your area to give you a call just to make sure that you're happy with all the answers to our questions, if you need any further clarification. So that'll happen in the next 24 to 48 hours, you'll receive a call. There's no more questions that I can see that have come through. So thank you, Paul and Rita, and I'll hand back to Rita to wrap things up.
Thank you very much, Justin, for helping us out with the chat facility and also jumping in when we had a little bit of a glitch with Paul, but that's what happens in this world. And I hope everybody has enjoyed the webinar today. Thank you for joining. I hope that if you are in lockdown, that hopefully you'll be out and about soon again. I'm not quite in the same situation. I just have different rules and regulations about what I can do in Port Macquarie as well. So, but I wish you all the best, and certainly reach out if you need any assistance whatsoever. And thanks, Paul and Justin, again.
Thank you. I'm going to end the meeting now. Bye-bye.
Thank you.